There's something odd happening with home prices in the villages right now, and it's not just that they're moving in one direction or another, it's that nobody seems to agree on what direction that actually is or how far things have shifted. And if you want to verify any of the information I'm about to walk through, I've put direct links in the pinned comment below so you can check the numbers yourself, see where they're coming from. Zillow has the average home value at just over $409,000, down about 2.8% from a year ago, which sounds like a modest pullback. Nothing alarming, but then you look at what Redfin is showing for the median sale price, and it's $350,000, down nearly 8% year over year. And Movoto is reporting something closer to $369,000 in their January data, also down around 7 or 8%, depending on how you calculate it, and that's a $60,000 spread between the high and low estimates, which isn't a rounding error, it's a fundamental disagreement about valuation. And when platforms that serious buyers and sellers rely on can't land within even 10% of each other, it suggests the market itself has become difficult to read. Part of what's creating that confusion is the way sales activity has slowed, not collapsed, but slowed in a way that makes it harder to establish what things are actually trading for. Because in December of last year, only 231 homes sold in the villages, and sales volume overall is down more than 23% compared to the same period a year earlier, so there are fewer transactions to use as reference points, fewer comps that feel current, and homes are sitting on the market now for a median of 72 days, which is more than double what it was during the tighter inventory periods a couple years back. So the data that does exist is older, slower to refresh, and reflects a market where buyer urgency has clearly faded. What makes that pullback in sales volume particularly notable is that it's happening at the same time inventory is rising, not dramatically, but steadily, with more than 2,300 properties listed for sale right now, and forecasts suggesting that number could climb another 5 to 10% in the coming months. So you have more homes available, fewer people buying them, and prices that, depending on which platform you trust, have either barely moved or dropped significantly. And all of that is playing out in a community where the entire value proposition has always been predictability, consistency, the sense that this was a place where the systems worked and the market behaved in ways retirees could count on. Institutional investors, the ones who are buying properties in the villages as long-term rental holds or flips, are still present. There are more than 4,000 landlords in the area owning over 11,000 properties worth close to $900 million. And there are another 4,000 or so active flippers, but the villages now ranks 83rd among Florida markets for investment activity, which means it's dropped considerably as a target for that kind of capital. And when institutional money starts ranking a market that low, it usually signals that the return assumptions have changed, that the growth curve doesn't look as attractive as it did, or that risk has entered the equation in ways that weren't there before. At the same time, there's a tension building around rentals that most people outside the community probably don't see because a small but growing number of homeowners have been listing properties on Airbnb or other short-term platforms, trying to generate income to offset HOA fees, property taxes, insurance costs that have climbed steeply, and the average Airbnb in the villages is bringing in about $19,000 a year with an occupancy rate around 45% and nightly rates averaging $170. But only about 1% of those listings are actually licensed, which suggests enforcement has been light or non-existent. And now you have residents pushing back hard, saying they want rental restrictions like other 55-plus communities have. No rentals shorter than 3 months. Renters required to meet the age threshold, because the whole point of living in an age-restricted community is maintaining that environment. And if short-term renters who may not be 55 start cycling through properties, it changes the feel of the place, and that conflict between people trying to make their investment pencil out and people trying to preserve what they moved there for, that's not going away. It's going to require decisions from the HOA or the developer or both. And whatever gets decided is going to affect property values one way or another, because it either limits income potential or it alters community character. The equity picture is complicated too, because while prices have softened and sales have slowed, there are still nearly 56,000 properties in the villages where the owners have more than 50% equity and more than 37,000 homes that are fully paid off, which means a large portion of the homeowner base isn't facing immediate financial pressure. They're not underwater, they're not getting foreclosure notices. In fact, there are only 32 properties in pre-foreclosure right now, which is low, almost surprisingly low given the broader market softness. And what that tells you is that most people who own in the villages can afford to wait. They don't have to sell. They're not going to panic and dump properties at steep discounts. But it also means inventory is going to stay elevated because homes that might have sold quickly 2 years ago are now sitting. And sellers who don't absolutely need to move are holding out for prices that buyers aren't currently willing to pay. So you get the standoff where nothing moves quickly and price discovery becomes harder because fewer transactions are actually closing. Then you have the forecasts, and this is where the uncertainty really shows itself, because some analysts are projecting modest gains for 2026, maybe 2 to 4% appreciation as the market stabilizes and finds a floor, while others are maintaining that the trend is still downward. That the forecast score, which measures price direction on a scale of 1 to 100, is sitting at 28, which is deep in negative territory, and they're calling for continued declines through this year and possibly into next. So, depending on who you listen to, the Villages is either bottoming out and about to recover, or still in the early stages of a longer correction. And both views are being presented with data, both are coming from sources that people trust, and there's no clear way to know which one is going to be right until more time passes and more sales close and the pattern becomes undeniable. What's difficult about all of this is that the Villages was built and sold on the idea that it removed uncertainty, that retirees could move there and not have to worry about whether their home would hold value, whether the infrastructure would stay solid, whether the lifestyle they paid for would remain intact. And for a long time, that was more or less true. Prices climbed steadily, inventory stayed tight, demand felt relentless, but now the questions are harder. The answers are less clear, and the confidence that held the market together is showing cracks, not breaking, but definitely showing strain. And when confidence erodes in a retirement community, the effects aren't always immediate. They show up in longer days on market, softer offers, price reductions that weren't expected, buyers who take more time, ask harder questions, compare options they weren't comparing before, and sellers who thought they were in a strong position suddenly find themselves negotiating more than they anticipated. The broader context matters too, because the Villages isn't operating in isolation. Florida's insurance market is still unstable. Property taxes are rising across the state. The cost of living in retirement communities has increased significantly, and people are making different calculations now than they were 3 or 4 years ago. They're weighing proximity to family more heavily. They're factoring in healthcare access in ways they didn't before. They're looking at total monthly costs, not just the purchase price. And when all of those variables shift at once, the market responds, not with a crash necessarily, but with a recalibration that can take years to fully play out. And right now, the Villages is in the middle of that process, trying to find equilibrium between what sellers believe their homes are worth and what buyers are actually willing to pay. And until those two numbers converge more closely, the market is going to feel uncertain, transaction volume is going to stay suppressed, and the question of whether prices go up, go down, or stay flat is going to remain genuinely open, not because the data doesn't exist, but because the data itself is conflicted, incomplete, and being interpreted in fundamentally different ways by people who all claim to be looking at the same market.